Silver or crypto? What is the investment that best carries us forward? The real difference here is growth versus investing. Are we investing in assets that hold inherent value or assets that grow in value over time? And the reality is that every asset usually has a little bit of both. So, what is more important at this moment? With all of the chaos swirling around us, you know, people throwing out the words recession and depression and financial collapse, what is the correct option? What is the way that we come out of this ahead? And so I wanted to dive a little bit into growth versus value investing. With growth investing, it's primarily we're looking at assets that don't have inherent value, that intrinsic value is not there primarily. What people are looking at is something that will have value in future, will have utility, really, utility in future. Whereas with value investing, it's something that already has utility and therefore already has that intrinsic value. People need it. People want to use it. And that is what makes it valuable. And when you've got that, things like coal and oil and gold and silver and land, those things always retain value because they serve certain utility and people need them for their utility. But when it comes down to it, why isn't everyone just buying utility if it's such a great proposition? Well, because often the utility of something is not correctly priced in by a market. So, for example, there are a lot of assets that collapse at the same time as, say, the stock market, that fall at the same time as the stock market, that really shouldn't, that hold that intrinsic utility, right? But they fall anyway. And when they do fall, you've got a real opportunity there because it's like, hey, that intrinsic value is not going away. That item is still going to be needed by people in the future. But the difference is usually that increase is not a whole lot, right? Things generally don't fall to 1/100th of their value. And so finding something with those insane returns that is value investing is fairly difficult. And so the majority of the focus shifts towards growth investing. And growth investing is it's primarily reliant on the trend. Is this thing going to become useful in future? And if the answer is yes, then okay, you have something that's potentially very profitable because people don't usually invest large portions of their of what they have in things that they consider risky. And startups, new things are considered risky. Now, that's not to say that people don't take risks. People take a ton of risks, but it's what they perceive as risky that they won't really they don't usually shift into on the average. So if we're looking at growth opportunities as these sort of like high value, high potential opportunities, and value investing, or having more of a prevalence of high value opportunities, and value investing having a lower prevalence of high value opportunities, then the focus definitely shifts towards growth investing. But I think we're sort of missing the mark here, because the idea of value investing is that it protects you. If you buy something for a lower than average price, and you know that in the future someone is going to need it, and that the average value of that thing is higher than what you paid for it, then you can be assured, you have a very high likelihood that you'll be able to recoup what you put into that and more. Whereas with the growth investing, it's dependent on so many factors. Whether a startup is successful or not, whether whether a new technology is adopted or not, those things are not assured. They're not for sure. Something could change. That new technology might turn out to be obsolete because another technology just completely erases it. A prime example was when the telegraph first came out. The telegraph was not electrical when it was first invented. The first step was the optical telegraph. And I believe it was France heavily invested in optical telegraphs. And what this was a giant contraption every few miles or so that would have these arms that would swing and make kind of like semaphore, the signal language that the other telegraphs could read and transmit down the line. And it was a genius idea at the time. They were transmitting messages way faster. And then someone had to go and discover or create the electric telegraph. And the minute that happened, the optical telegraph became obsolete. Because what took minutes to transfer suddenly took seconds. And so all that infrastructure, all that money became wasted overnight, or nearly wasted. And that type of thing happens a lot, where a technology like Betamax, or any of Blu-ray, there are certain technologies that kind of just get skipped, and that's not uncommon. So those ventures are very risky, and those assets are very risky. And when we shift to value assets, we increase the likelihood of success. And therefore, we assure ourselves that we can compound that success. Or we have a higher likelihood of compounding that success, right? Because that's really all life is about, is higher or lower likelihoods, right? Nothing is ever for sure. But we have a higher likelihood of success. And succeeding over and over and stacking that success is the way that we grow rapidly, in a stable way. You can have wild success from something risky, but can you have wild success from something risky consistently? That's much harder to do. And if you're wrong, if you make a mistake, the stakes are much greater. So the value investing protects us. It adds a layer of shielding. But it also makes it harder for us to achieve that wild success. We have to work harder for it. And I think there's a great parallel here, not just in investing in assets, but investing our labor. When we invest our labor, it's the same. It's value investing versus growth investing. It's a ratio. What percentage of the labor that we're putting in, what percentage of that is growth investing, is stuff that we're doing hoping to get a future return that does not exist currently, and how much of that is value investing, is doing something that we know is valuable, that we know will get a return, because that's already been determined. And when we find the right ratio, when we make that shift to, okay, what percentage of what I do is going to be growth versus value? What percentage of what I do has that higher assurance of success? When we start to stack that, the success starts to accumulate and compound. And, as Albert Einstein said, compound interest is the eighth wonder of the world. Compounding is amazing, and we can compound so many things in our life. I think our time, our labor, our assets, we always go to assets when we think of these financial concepts, but there's so much more there. And more I'm starting to realize that I need to be reframing this so that I'm looking at my time as a valuable resource that I'm investing, my attention. So what I wanted to do today was kind of take a look at the reality of investing trends right now. I titled this Silver versus Crypto, because silver represents, in my mind, that value investing, finding something that already has proven its value. It's used in electronics all around the world. It's used in every solar panel. It's used in so many different ways in our society, and so it has real, tangible utility that can be measured. And the current value does not match up to the value of the utility. So I consider that a prime example of a value investing opportunity. And I see crypto as a prime example of a growth investing opportunity. Something that has not yet been tested in the market in which it's trying to carve out its place. Something that is just emerging and just starting to see successes on a small scale. So the question is, with all this chaos around us, moving forward, do we want to lean more towards the value investing or more towards the growth investing? And I've got an interesting proposition for you. And what I'd like to do is sort of take a look at the reality of investing trends right now and create a sample portfolio of sorts. So for this, what I'd like you to do is grab a piece of paper. Right now, just go ahead and grab it. You can pause the video and just come back in a second, or pull up a note-taking app if you're on your computer or your phone. And once you've got your piece of paper, just put a line down the middle. And then on one side, write growth, and on the other side, write value. And then what I want you to do is put the long-term trends in the top left and the top right. The growth long-term trends and the value long-term, or not just the trends, the actual trades that you've identified. So, you've looked into the trends, you found a few opportunities, those opportunities, you put the long-term ones in the top left. So you've got the long-term growth, and then you've got the long-term value in the top right. And then in the bottom left and the bottom right, I want you to look at the short-term trades, the short-term opportunities. Short-term growth in the bottom left, short-term value in the bottom right. And what we're going to do is write down 10 of those opportunities that you could take advantage of. And put down, you could put down more than that if you have space for it. The idea is to come up with a pool of solid stuff, not anything out there, but the things that you think could actually be a valuable trade. And have each of these quadrants. You want your growth long-term, growth short-term, value long-term, value short-term. And form these into a sort of sample portfolio by taking the top 3 in each quadrant. So 3 growth long-term, 3 growth short-term, 3 value long-term, 3 value short-term. And then take that pool and use that as a seed for a sample portfolio. Now you've got something where you're like, okay, I've got long-term trends, I've got short-term trends, and how I balance within these, that'll differ from person to person. It's kind of just up to you based on how you see things playing out, right? But now you've sort of got this concept of, okay, I've got this side of my portfolio are the things that hold intrinsic value, that people will need, that are just undervalued. And this side of my portfolio is the things that I think people will need in future that don't currently hold a lot of utility. They're more to the growth side than they are the value side. And it is a spectrum, but you kind of just eyeball it and decide which one goes in which category. And once you have that list, now you've got a portfolio that you can customize to your liking and kind of prepare for this economic damage that's coming. And if you have a bit more to play with, then what you could do is create a mirror image of this. Now you've got your 12 that you're using as a portfolio, your growth and your value. Now create the exact opposite of that. If you can't find trades that are the exact opposite, then find a way to bet against some of the trades in this list, right? There's almost always a way to bet against something, especially in the stock market. In crypto, might be a little more tricky, but there's a few ways to do that as well. But yeah, take advantage of that. Say, look, I'm going to bet against myself. And then decide how much you want to bet against yourself. And essentially what we're doing there is protecting ourselves against hubris. Because there is always this loss of vigilance when we start to feel that we're succeeding. And often right before the biggest successes or right after the biggest successes come some of the biggest losses. So what we want to do is protect ourselves from a loss of vigilance, from mistakes. And if we're right one way or the other, if we're going after opportunities that are inherently valuable, then it shouldn't matter that we have chips on both sides of the table, because what we lost in securing these assets here will come out of the success of having having bet against ourselves over here, right? And so that that concept of damage coming right after success, it's, you know, we see it all throughout history. You know, the concept of the feigned retreat in battle, right? You know, Leonidas and the Battle of Thermopylae. You know, the origin of the 300 Spartans story. They used that tactic there. They pretended to run away and use it to trap the enemy soldiers and decimate them. And in the end, yes, they lost, but it's gone down as this heroic myth because of how hard fought that battle was. With so few men, decimating an unbelievably large force like that, it's, you know, it echoed through history. And similarly, you know, there will be other aftershocks when we get excited, when we get happy, and we start to lose that sense of vigilance. When we've done something successfully, we need to protect ourselves and start locking in some of those gains. You know, moving into value to make sure that we've secured the gains that we've achieved. Right? Lock in those checkpoints, those anchors, and those moments come at you so fast and so hard. The times in my life where I've had the most amazing investing success were the times right before I had the most horrifying investing failures. So we need to protect ourselves, and we need to realize that when we're up, we should be pulling out a segment of that. Every time we take a step up and we're at a new level, pull out a chunk. Pull out a chunk and put it in value. Put it in something that will hold its value over time, or at least not lose much of its value over time. Because those things will allow us to step ladder our way up. And if we can keep compounding that success, keep inching our way upwards, step by step, and locking in those platforms, those checkpoints, then we're going to climb way higher, way faster. I hope you guys have had a wonderful Thanksgiving, and I hope you have a wonderful Christmas. I'll see you next week. Thanks for watching.